Ever wondered how central banks manage the money supply in a country's economy? Welcome to a journey into the fascinating world of finance, where we'll unravel the mysteries of cash reserve ratio, CRR, statutory liquidity ratio, SLR, repo rate, and reverse repo rate. Let's start with the cash reserve ratio, or CRR. Picture a vault in a bank, chock full of cash. Banks are required to keep a certain percentage of their deposits in the form of cash reserves with the central bank. That's the CRR. The central bank uses this to control the amount of money in circulation. If the CRR is high, banks have less money to lend, which can help cool down an overheating economy. On the flip side, a lower CRR means more money for banks to lend, stimulating economic activity. Now let's talk about the Statutory Liquidity Ratio, or SLR. This is the percentage of deposits that banks need to maintain as liquid assets, such as cash, gold, or government securities, within their own vaults. It's a safety net, ensuring that banks always have a cushion to fall back on, even in times of financial stress. When SLR increases, banks have fewer funds available for loans, which can help slow down inflation. Conversely, when SLR decreases, banks can lend more, boosting economic growth. Next up, the repo rate. Think of it as the interest rate at which the central bank lends money to commercial banks. If the central bank wants to reduce money supply and control inflation, it increases the repo rate, making borrowing more expensive for banks. If it wants to stimulate growth, it reduces the repo rate, making borrowing cheaper. Lastly, we have the reverse repo rate. This is the rate at which the central bank borrows money from commercial banks. An increase in this rate can absorb excess liquidity from the market, as banks prefer to lend to the central bank, while a decrease can inject liquidity into the market. Now, let's recap. The cash reserve ratio and statutory liquidity ratio are tools that central banks use to ensure financial stability and control the amount of money banks can lend. The repo rate and reverse repo rate, on the other hand, are tools that central banks use to control money supply and manage inflation. These seemingly complex terms are nothing more than levers used by the central bank to navigate the economy. They are like the strings of a puppet, guiding the dance of money in the economy. So, the next time you read about these terms in the financial news, remember this journey into the world of finance. After all, the more you know, the better you can navigate the ocean of economics.